Welcome back to the Daily Crypto Roundup. Coming up today, we're breaking down why Bitcoin is holding the low $90,000 range despite fresh ETF inflows, and what that tells us about institutional positioning rather than retail momentum. We'll look at Ethereum's staking queue surging past 2 million, and why large players are locking supply away instead of selling into this market. We're also covering a major update out of Washington, where US lawmakers have released new language in the Digital Asset Market Clarity Act, including what it really means for stablecoins, rewards, and future regulation. On the risk side, we'll go through newly released data showing more than $4 billion lost to hacks and scams last year, what caused the biggest breaches, and why recovery rates remain so low. We'll also touch on developments in Asia around unlicensed crypto trading, a new Bitcoin and gold investment product hitting traditional markets, and a couple of attention-grabbing meme stories that need a reality check. If you want the facts, the context, and what actually matters beyond the noise, stay with us. Let's start with the broad picture first, because context matters here. The global cryptocurrency market cap today is sitting just above the $3 trillion mark, roughly in the 3.1 to 3.2 trillion range depending on the hour. That puts the market modestly higher on the day, up around 1 to 2%, but crucially, this is not a breakout move. This is not the start of a parabolic leg higher. It's steady, controlled, and cautious. Trading volumes are healthy but not excessive, hovering around $110 to $120 billion across the market. That tells us participation is still there, liquidity is still there, but traders are not rushing in aggressively. This is not fear-driven behavior, but it's not euphoria either. Sentiment reflects that. The Fear and Greed Index remains firmly in neutral territory, hovering in the low 40s. That's important because it tells us something very specific about market psychology right now. Investors are not scared enough to capitulate, but they are also not confident enough to chase price. That combination almost always produces sideways action, and that's exactly what we're seeing. Bitcoin today is trading in the low $90,000 range, roughly between $92,000 and $93,000 for most of the session. Ethereum is sitting just above $3,100, with small fluctuations but no decisive move. Binance Coin is hovering around the $900 mark. Solana is holding in the low 140s. XRP remains around $2.07. Cardano is stuck under 40 cents. Dogecoin continues to drift just below 14 cents. None of these moves are dramatic, and that's the point. This is a market that is waiting. Now, when a market waits like this, the question becomes, what is it waiting for? And the answer today is fairly clear. It's waiting for macro clarity, it's waiting for regulatory certainty, and it's waiting for a catalyst that justifies breaking out of this range. That doesn't mean nothing is happening. Quite the opposite. A lot is happening quietly. Let's talk about Bitcoin specifically, because despite the lack of fireworks, Bitcoin continues to do something very important. It's holding its ground. We've seen multiple attempts to push price lower over the past couple of weeks, particularly around macro data releases, but each dip has been absorbed. There is no cascade of forced selling. There is no liquidation spiral. Instead, Bitcoin continues to trade in a tight range between roughly $91,000 and $94,000. This kind of price behavior is often misunderstood. Retail traders tend to get bored during consolidation phases and assume nothing is happening. Institutions, on the other hand, tend to love these environments. Sideways price action allows large players to build positions without moving the market against themselves. And today's ETF data supports that idea. US spot Bitcoin ETFs recorded another net inflow session, with over $100 million flowing into these products in the most recent trading window. That pushes cumulative inflows since launch well beyond $55 billion. This matters because ETF flows are not speculative retail money. They represent pension funds, wealth managers, family offices, and institutional allocators who are building exposure slowly and methodically. What's particularly interesting is that these inflows are continuing even though price isn't moving aggressively higher. That tells us something very important. These buyers are not momentum traders. They are positioning for the long term. They are comfortable accumulating at these levels, even without short-term upside confirmation. On-chain data also adds an interesting layer today. Several large Bitcoin transfers have been observed moving from known institutional linked wallets into new addresses. These kinds of movements often spark speculation about impending sell-offs. But there is no evidence today that these transfers represent distribution. In many cases, these moves are simply custody reshuffles, internal treasury management, or preparation for collateral usage. Until we see corresponding exchange inflows, there's no reason to assume bearish intent. Ethereum, meanwhile, is quietly telling a very different, but equally important story. One of the most significant developments today is the surge in Ethereum's staking activation queue. Over 2 million Ethereum are currently waiting to be activated for staking. That represents roughly 3 to 4% of the entire Ethereum supply. The average wait time for new validators has now stretched to well over a month. This is not a retail phenomenon. This is institutional behavior. Large entities are committing capital to Ethereum, not just as a speculative asset, but as a yield-bearing instrument. When you stake ETH, you are locking it up for the long term. You are signaling confidence in the network's future. And when this much ETH moves into the staking queue, it reduces circulating supply, which, over time, has meaningful implications for price dynamics. A significant portion of this recent staking surge is linked to institutional activity, including large deposits from professional crypto firms. This reinforces a narrative that has been building quietly over the past year. Ethereum is increasingly being treated as digital infrastructure rather than a high beta trade. It's becoming something closer to a productive asset. Now, while prices remain range-bound, the regulatory landscape today took a meaningful step forward in the United States. And this is not hype. This actually matters. Lawmakers have released updated language for the Digital Asset Market Clarity Act, a bipartisan effort aimed at defining how digital assets are treated under U.S. law. The most important change in today's update is the explicit allowance of what lawmakers are calling activity-based stablecoin rewards. In simple terms, this means that stablecoins will be allowed to offer rewards tied to usage, payments, and network participation, but they will not be allowed to pay interest simply for holding balances idle. This distinction is critical. It shows that regulators are no longer trying to kill stablecoins or force them into the banking system. Instead, they are trying to prevent stablecoins from becoming shadow banks while still allowing them to function as programmable money. That's a massive shift in tone compared to where we were just a couple of years ago. Senators involved in the bill have made it clear that the goal here is transparency, consumer protection, and innovation, not prohibition. Markups on the bill have been delayed until later this month, but the fact that the language is now public and constructive is a major positive for the industry. This kind of regulatory clarity is exactly what institutional capital has been waiting for. It doesn't generate instant price spikes, but it lowers long-term risk. And that's how serious money thinks. Outside the US, regulatory enforcement continues to tighten in a more targeted way. In Thailand, authorities have filed criminal charges against individuals accused of running unlicensed trading services for WorldCoin. The key takeaway here is not that crypto is being banned. It's that regulators are enforcing licensing requirements. This is the same pattern we've seen across much of Asia. Legitimate projects are allowed to operate, but unregistered platforms face consequences. For the market as a whole, this kind of enforcement is actually healthy. It removes bad actors without suppressing innovation. On the product side, we've also seen something interesting out of Europe today. An asset manager has launched a new exchange-traded product that combines exposure to Bitcoin and gold. The product dynamically adjusts allocation based on volatility, increasing exposure to gold when Bitcoin volatility rises, and increasing Bitcoin exposure when conditions stabilize. This is important because it signals something about how crypto is being framed to traditional investors. Bitcoin is no longer being marketed purely as a speculative asset. It's being positioned alongside gold, as part of an inflation hedging, portfolio diversifying strategy. That framing may not excite crypto natives, but it absolutely matters for capital inflows from traditional finance. Now, no daily roundup would be complete without addressing security. And today's data provides a sobering reminder of the risks that still exist. A comprehensive report released today shows that over $4 billion worth of crypto was stolen through hacks and scams over the past year. That's a significant increase year on year. The majority of these losses came from hacks rather than scams, and a small number of incidents accounted for a disproportionate share of the damage. The largest single exploit involved a major exchange losing over $1 billion due to a hot wallet breach. Other notable incidents included decentralized exchange exploits and protocol vulnerabilities. What's particularly concerning is the recovery rate. Less than 10% of stolen funds were recovered. That underscores a harsh reality. Once crypto is gone, it is usually gone for good. The report also highlights the ongoing role of state-linked actors, with over half of stolen funds traced back to groups associated with North Korea. This has serious geopolitical implications and ensures that crypto security will remain under intense scrutiny from governments. Shifting gears briefly to NFTs and the broader Web3 space, activity remains muted. There has been a small uptick in NFT market capitalization at the start of the year, but volumes remain far below previous peaks. Total NFT sales last year were down more than 30% year-on-year. The speculative frenzy is gone, and what remains is a much smaller, more niche market focused on utility and community rather than flipping JPEGs for profit. DeFi, meanwhile, is stable, but quiet. Total value locked has not moved significantly, and most major protocols are in maintenance mode rather than expansion. The stablecoin regulatory debate has caused some projects to pause new reward programs, but there is no systemic stress visible in the data. Before we wrap up, it's worth addressing a couple of attention-grabbing stories that are circulating today, not because they are fundamentally important, but because they are getting attention. One involves a popular meme ecosystem attempting to address losses from a previous hack by issuing NFTs that act as proof of debt records. These NFTs do not contain funds. They are essentially IOUs recorded on-chain. Any actual recovery depends entirely on future fundraising efforts. This has been marketed by some as a recovery mechanism, but investors should understand exactly what it is and what it isn't. Another story involves a politically linked meme token that launched with fanfare, surged in market cap, and then collapsed almost immediately. This is a textbook example of why hype without sound token design is dangerous. Political branding does not create value. Liquidity, decentralization, and trust do. And when those are missing, price collapses quickly. So where does that leave us today? It leaves us in a market that is calm, cautious, and quietly constructive. Bitcoin and Ethereum are holding key levels. Institutional money is flowing steadily, not dramatically. Regulation is becoming clearer rather than more hostile. Security risks remain real, and speculative excess still gets punished quickly. This is not a market for chasing headlines. It's a market for paying attention to structure. And structurally, nothing today suggests panic, collapse, or euphoria. What it suggests is preparation. And when markets prepare quietly, they tend to move loudly later on. Drop your thoughts in the comments, smash like, follow, and as always, we will see you at the top.